Hello, my friends. This is Doug Fabian. Welcome to my weekly ETF report. Today is Tuesday, August 4th, 2015. I'm coming at you a little bit early this week in this recording because I'm going to be out of the office at a business conference the latter part of this week. I still want to be here for you each and every week to give you ETF investing ideas and help you with your strategies overall. Let's begin with the financial markets because there's some really important messages coming through right now. The emerging markets, which represent 50% of global growth, as you look at the ETFs for emerging markets, they are submerging. We are near 52-week lows on the emerging market stock ETFs, and this is telling me that global growth is continuing to slow and it's problematic going forward. Second, we have the commodities markets. These are also near their 52-week lows, have been in a 2-year bear market. The price of oil is down 61% over the past 12 months. And this is also indicating slower global growth, especially from China. And then, of course, we have the interest rate environment where the Fed is looking at raising interest rates in September to get the U.S. economy back to a more normal monetary policy. All three of these things are warning signs. As a matter of fact, in my investment newsletter, Successful ETF Investing, I have issued sell signals technically for stocks in the U.S., stocks internationally, and precious metal stocks. It's highly unusual to have all three of these plans signaling a sell at any one point in time. So what should you do? I suggest as we go through this hot zone of August, September, and October that you're more cautious with your investment strategy and look at the potential for market weakness as a buying opportunity. Now let me move to innovation in the world of exchange-traded funds, and I want to talk about a specific term. It's called smart beta. This is a way to identify a certain type of exchange-traded fund where they have taken an index, a market index, and changed it in some way to get a better outcome. Now, I have a chart for you. This chart is a 3-year picture of SPY, the S&P 500, versus RSP, the RightX Equal Weight ETF. Now, what's an equal weight ETF? It's an exchange-traded fund where all 500 stocks are of equal weight within the index, as opposed to the S&P 500, which market cap weights those stocks. So for instance, Apple Computer, the largest stock in the S&P 500, has the most influence on that index. Over the last 3 years, the equal weight index has outperformed the basic SPY by about 10 percentage points over 3 years. So you've gotten better performance in a rising market from an equal weight ETF. This is because small cap stocks have actually done better than large cap stocks, and that's what's giving you that extra performance. Now let me give you another example. We have SPY versus USMV. USMV is an ETF that selects only the low volatility stocks within the S&P 500. So what the objective of this ETF is not to give you a better performance, it's to give you a smoother ride. I went back and looked at market corrections with this exchange-traded fund, and I found that it performs much better on the downside. Now you give up some upside performance with this ETF, but you get better downside performance, making it a smoother ride. Both of these exchange-traded funds are smart beta ETFs, whereby they have tweaked the underlying index to come up with some different results for investors. I hope this helps. Thanks so much for tuning in. Remember, you can send me your emails, askdoug@dougfabian.com.